or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 182, and in this episode we're reviewing the performance of the financial markets during the 42nd week of 2025, and that is from Monday the 13th to Friday the 17th of October. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Tuesday, the Federal Reserve Chairman Jerome Powell suggested that the central bank was nearing a point where it would stop reducing the size of its bond holdings, and provided a few hints that more interest rate cuts were in the pipeline. Speaking to the National Association of Business Economics conference in Philadelphia, the chairman provided a dissertation on where the Fed stands with regards to quantitative tightening, which refers to the central bank's effort to reduce the more than $6 trillion of securities that it holds on its balance sheet. However, Powell did not provide a specific date when the program will come to an end, but said there were indications that the Fed was nearing its goal of ample reserves for banks. On interest rates, the chairman did not provide specific guidance on a path lower, but comments about weakness in the labor market indicated that lower interest rates were firmly on the table. Staying stateside, on Thursday, the Treasury Department announced that the U.S. budget deficit had reduced slightly in 2025 on the back of a record collection in tariffs that helped to offset rising payments on the national debt. President Trump's tariff policy was a major contributor to the tariff collections of $202 billion in 2025, which represents an increase of 142% from the previous year, that is 2024. Even though the U.S. budget deficit reduced by 2.2% in 2025, it still came out at $1.78 trillion, which by historical standards is way too high, even for the largest economy in the world. Over to the United Kingdom, where according to the latest data from the Office for National Statistics, the British economy registered a marginal growth of just 0.1% in the month of August, which was in line with economists' expectations as production grew by 0.4%, whilst services showed no growth and construction declined by 0.3%. The slowdown in growth was not a surprise, as economists had already forecast a moderation in economic activity. The UK economy grew by a better than expected 0.3% in the second quarter of 2025, which was down from a 0.7% recorded in the first quarter, and that was boosted by the front-loading of business activity ahead of U.S. trade tariffs that were implemented in April. On Wall Street this past week, there was a global sell-off in banking stocks on Friday as fears of rising defaults in U.S. bank loans spilled over into the global equity markets. However, the stock market appeared to shrug off the credit concerns that sparked a massive sell-off in U.S. regional banks on Thursday. The Dow Jones Industrial Average rose on Friday as the market took note of the softening tone in trade talks between the United States and China. The softening tone suggests that the threat of additional tariffs against China might not come through. Despite increased volatility, all the three major indices finished the week on a higher note, fueled by a strong start to the third quarter earnings season. The broad market index, that is the S&P 500, rose by 1.7% during the week to close at 6,664, whilst the 30-stock Dow Jones Industrial Average was up by 1.6% for the week as it came to a close at 46,190. And the tech-heavy Nasdaq Composite gained by 2.1% over the same period as it eventually settled at 22,679. In the government bond market, U.S. Treasury yields rose on Friday, with investors initially concerned about a potential credit crisis in the banking sector, but those concerns eased off later in the session. Treasury yields were trading higher on Thursday following a flight to safe haven assets on concerns of rising loan defaults in the private credit market. However, after investors digested the news, opinion appeared to be shifting to the view that the loan default situation was manageable and was not the beginning of a broader credit crisis. Traders are also focused on other developments, including the trade talks between the United States and China, as well as President Trump's recent efforts to defuse the ongoing conflict between Russia and Ukraine. In response, the yield on the 2-year Treasury note rose by more than 3 basis points to close at 3.46%, whilst the yield on the benchmark 10-year Treasury bond was also up by 3 basis points to settle at 4% flat. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the US dollar was on track for a weekly loss against other major currencies on concerns about US-China trade tensions and signs of growing credit risk in America's regional banks, which drove investors into safe haven currencies such as the Swiss franc and the Japanese yen. Additionally, the ongoing government shutdown, which entered its 17th day on Friday, has choked off the release of key economic data, leaving investors with less certainty about what is happening in the U.S. economy. Concerns about trade tensions with China and the continued government shutdown is making the greenback vulnerable to the debasement trade, where investors are seeking assets that cannot easily be devalued, like gold and Bitcoin. In the commodity markets, the price of crude oil was flat on Friday, but ended up posting a weekly loss of more than 2%. This came after the International Energy Agency released a forecast showing a growing supply glut in the oil market, and as President Trump agreed to another meeting with Russian President Vladimir Putin to discuss the ongoing conflict in the Ukraine. This week's decline was also partly due to the rising trade tensions between the US and China, which added to concerns about a global economic slowdown with the consequent lower demand for crude oil. In response, the price of the global benchmark Brent crude was broadly stable at $61.29 a barrel, whilst the price of the US benchmark West Texas Intermediate crude was also flat at $57.54 per barrel. In the precious metals market, the price of gold fell by more than 2% on Friday after hitting a new record high above $4,300 per ounce, pressured by a firmer dollar and a softening tone in the US-China trade talks. Earlier in the session, gold was on track for its biggest weekly gain since September 2008, when the collapse of Lehman Brothers fueled the global financial crisis. The price of gold has surged more than 64% so far this year, driven by various factors, including geopolitical tensions, increased purchases by central banks, strong inflows into gold exchange-traded funds, as well as expectations that the Federal Reserve will continue cutting dollar interest rates. The price of spot gold hit a new all-time high of $4,378 and was set for a weekly gain of about 4.8% before finally settling at $4,211 per ounce. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. In the cryptocurrency market, Citibank is aiming to launch a new service for the custody of crypto assets as traditional Wall Street institutions expand their footprint into the digital currency space. The bank said that it has been developing a crypto custody service for the last 2 to 3 years and is making progress with a view to launching in 2026. For a long time, traditional financial institutions have stayed away from cryptocurrencies. However, that is now changing as the Trump administration has built a more favorable regulatory environment for digital assets. Case in point is the signing into law of the Genius Act, which looks to regulate the issuance of dollar-backed stablecoins, which has enabled traditional financial institutions to launch products and services related to these digital assets. And in related news, Absa Bank, which is a Pan-African bank, has entered into a strategic partnership with Ripple, which is a global provider of blockchain-based financial infrastructure, with a view to offering digital asset custody services in South Africa. This collaboration will enable Absa Bank to provide secure and scalable storage solutions for digital and tokenized assets using Ripple's institutional-grade custody technology. The partnership will allow the bank's customers to store cryptocurrencies and tokenized assets using Ripple's custody technology. Through this initiative, Absa aims to position itself at the forefront of digital finance innovation, offering clients a trusted platform for the safekeeping of their digital assets. We now change scene to the Kenyan financial markets. And as is the norm, we start by looking at the domestic foreign exchange market, where the Kenya shilling remained fixed versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24. Meanwhile, the sterling pound was priced at 173.38 and the euro was valued at 150.64. And on the regional front, one Kenya shilling was changing hands for 26.77 Ugandan shillings and 19.00 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.24. Despite the central bank operating a floating exchange rate policy, the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased significantly for the second week in a row, and this time by a jaw-dropping $844 million for a grand total of $12.07 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. This increase in forex reserves is attributed to the recent issuance of a new Eurobond for $1.5 billion that will be used to refinance the €1 billion Eurobond which matures in 2028 with a view to extending the maturity profile of the country's external debt. Despite this massive increase in reserves, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In related news, in the financial year ended June 2025, the Central Bank of Kenya has increased its gold holding by about 40% to a value of 238 million shillings, signaling a renewed drive to diversify the country's foreign exchange reserves amidst rising global economic uncertainty. The central bank move aligns with a global trend where major central banks are diversifying away from the US dollar and shifting to gold as a hedge against fiat currency debasement and volatility. On diaspora remittances, the inflow of remittances into Kenya totaled to $419 million in September 2025, up marginally from $418 million in September 2024, reflecting an increase of just 0.2%. Meanwhile, the cumulative inflows for the 12 months to September 2025, these increased by 7.6% to $5.08 billion. The inflow of remittances remains the main source of foreign exchange earnings and continues to support the country's balance of payments position as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market was liquid and remained well-funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined by 7 basis points from 9.30% the previous week down to 9.23%, which is in line with the central bank rate at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25, this stood at 3.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 16th of October, and the central bank received bids totaling to 27.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 114%. The central bank ended up accepting 27.2 billion shillings, and the results of the auction were as follows. The 91-day rate fell by 3.2 basis points to settle at 7.85%, whilst the 182-day rate dropped by 2 basis points to close at 7.90%, and the 364-day rate dipped by 2.5 basis points to average out at 9.36%. In the primary bond market, the monthly Treasury bond auction was held on Wednesday, the 15th of October, and the central bank received bids totaling to 118.8 billion shillings against an advertised amount of 50 billion shillings, representing a performance rate of about 237%. The central bank ended up accepting 85.2 billion shillings, and the results of the auction were as follows. For the first bond, which is a 15-year bond that was initially issued in 2018 and now has 7.7 years left to maturity, the central bank accepted 31.5 billion shillings at a weighted average rate of 12.65%, and this is compared to the bond's coupon rate at the same rate of 12.65%. And for the second bond, which is a 20-year bond that was initially issued in 2021 and now has 15.9 years left to maturity, the central bank accepted 53.7 billion shillings at a weighted average rate of 13.52%, compared to the bond's coupon rate at 13.44%. At the Nairobi Securities Exchange, as the price of gold continues to break new record highs in the international markets, domestic investors have also joined the gold rush for the Absa NewGold exchange-traded fund. The Absa NewGold ETF, which mirrors the price of gold in the global markets, has shown significant growth so far this year, with its price surpassing 5,000 shillings for the first time in mid-October 2025, making it one of the top movers at the Nairobi Securities Exchange. And according to data from AIB Investment Bank, the gold-backed exchange-traded fund experienced a turnover in excess of 100 million shillings during the past 1 week. The Absa NewGold ETF is a gold-backed exchange-traded fund that is listed on the Nairobi Securities Exchange, and this fund tracks the international price of gold and allows Kenyan investors to gain exposure to gold using Kenya shillings. As at the close of business on Thursday, the 16th of October, the price of the Absa NewGold ETF was trading at 5,335 shillings per unit. And just for your information, each unit of the NewGold ETF is equivalent to approximately 1/100th of an ounce of gold. Up next is our topical issue. And this week, we are looking at Kenya's move to swap part of its external debt from US dollars into Chinese yuan. The Treasury has converted 3 facilities that were used to finance the standard gauge railway from US dollars into Chinese yuan, reducing Kenya's exposure to the dollar in its external debt portfolio. Data from the Treasury indicates that by converting a total of $3.5 billion in SGR facilities into Chinese yuan, this has reduced the dollar's share of Kenya's external debt from about 52% and is now down to 44%, which is equivalent to about 2.4 trillion shillings. The Treasury has opted to use currency swaps in order to reduce Kenya's debt service obligations, which have been aggravated by expensive floating rate dollar loans, including the 3 facilities from Exim Bank of China that finance the construction of the standard gauge railway. The reduction in dollar-denominated loans will save Kenyan taxpayers billions of shillings in annual interest repayments due to the difference in interest rates between the US dollar, where the policy rate is hovering around 4%, whilst the benchmark rate for the Chinese yuan is currently pegged at 3%. The currency swap from US dollars into Chinese yuan will save the country about 28 billion shillings a year in interest repayments. In addition to the financial relief, the Treasury also noted that the currency swap was advised by the need for diversification, given that Kenya's external debt is mainly concentrated in US dollars, which exposes the government to significant currency and interest rate risks. The currency swap also advances the move by the BRIC nations to de-dollarize the global economy by reducing the over-reliance on the US dollar for cross-border trade and finance. And on that note, we come to the end of this week's podcast. Thank you as always for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends, and also help to keep them informed of the latest developments in the financial markets so that they can make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, and that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, your thoughts shape you, your habits build you, and your choices define you. Think about it. Thank you, and God bless.